Uh, Good morning, guys. Today I just want to do a quick video, kind of go over our General Electric trade, why we chose to go uh, long General Electric, usually in the Dow stocks. Well, really any stock. I'm only wanting to buy if I can make a 20% return. Um, GE doesn't quite fit that bill. I've got a I'm looking at roughly in the next 12 months. I think that they could see about a 10% um, price increase, as well as they're paying about a 5% dividend. So you're looking at, with General Electric, probably around a 15% um, growth over the next year. Again, and that's just a rough estimate. So, like I said, it falls a little short of what our typical, when we would typically invest. But this most recent quarter, and honestly, with Dow stocks, if you can get in at about at almost a 5% dividend, there's two Dow stocks that are paying that: Verizon and GE. I've talked about Verizon before. I love Verizon stock. I see it's sold off. So maybe time for me to look back into that, because I was looking at buying it around $48 and it's down to 45 and a half today. So maybe time to go ahead and get back in, or look at initiating a position in Verizon as well. But again, that's not what we're talking about today. We wanted to just talk about GE. So again, I can see it with about a 10% price growth in the next year. And here's kind of some of the different things that I look at when I'm looking at investing in stocks. So if we look at GE, their year over year sales growth, they're basically flat. So we're looking at a company that's pretty much completely flat on sales growth. So that's a negative. You want a company that's growing sales year over year. They have current outstanding share repurchase program, where they can repurchase up to 12% of their stock. So if senior management feels the company is undervalued, fairly valued, they may be picking up additional pieces of that 12%. So that's a good way to look at, as I've said in the past, when we're looking at share repurchases. I'm going to go out and take a look and see if they've done any in the most recent quarter. But when we're looking at share repurchases, what we're looking at is if they are going to put a baseline in, that anytime that's where the company's willing to buy. So that the company feels that that's a good value. So that probably means it's a good value for you, the everyday investor, or you, me, whoever, that it's good value. I need to find, let's see, where the heck, okay, my SEC, there it is, company filings. So while that's pulling up, we'll go ahead and talk about their dividend growth. So in the last year, they've raised their dividend from 23 cents a quarter to 24 cents a quarter. So, it's only a penny, but you're more looking at the percentage, right? That's what you're looking to get into. You want percentage gains. So obviously that's about a 4.5% growth. So if they keep growing that dividend at 4.5% a year, right, that 24 becomes 25. Pretty quickly, you're up to 30 cents, 40 cents a quarter, and it just keeps kind of snowballing up. So that's a positive. So we mentioned their net sales, or their sales growth, is flat. We don't like that. Share repurchase, we've got to find what they're repurchasing at, and then the dividend growth. On top of Again, almost a 5% dividend ratio is pretty outstanding for a Dow company. So let me get to the financials. I'm trying to pull up their 10Q to get the dividend or the repurchase figures. Okay. So far this year, they've repurchased about $2.6 billion versus $17 billion last year. Obviously, you know, there was a recent, well, you may not know, but if you are into the stocks like I am, GE recently replaced their CEO. The prior CEO was let go. They got a new guy in there now. He's only been there a few months, but he seems to know pretty well what he's doing. So, okay, so here's the perfect example. This is what I was looking at. In the last quarter, they repurchased 2.7 million shares at an average price of $25.11. The stock's currently trading at $20. So that means that's 20% below what the company feels that their stock should be worth. That's telling me that if you're getting in at 20 bucks a share, you're getting pretty good value, because the company's going to continue to buy shares back down here at this price, because they feel like they've got things turned around and they're going in the right direction, and I would definitely agree with that. So let's look. So their most recent full year earnings is 75 cents, which gives them a current PE multiple of 26.84. That's the price to earnings multiple. Basically, you're taking their earnings, take the price of the stock divided by the earnings, and that's your PE multiple. So they're currently at 26.84. Their historic average, so if you look at their 5-year historic average, it's 23.9, and their 10-year historic average is a 17.48, which tells me that, so technically they're slightly overvalued compared to historic. Okay, so that's a negative, right? It may come down a little bit based on that. But again, with sales pretty much flat, the dividend growing the way it is, and their ability to repurchase shares, and obviously, the desire to repurchase shares at 25 bucks a share, I feel like GE is a good value right here at 20 bucks. So if you saw my post on Friday, I mentioned that I actually bought 100 shares at $19.94 a share. In that, so what we did, we purchased the 100 shares. Immediately after purchasing, we sold a call option against our 100 shares. All right, so we sold that call option at 30 cents a share. Basically, the easiest rundown of that is, so it's what's called a covered call position. Essentially, we have the 100 shares. We sold the call at 22 bucks a share. If the stock trades above 22 bucks a share, then the person who bought the call can exercise that option. If they do exercise that option, then we have to give up our 100 shares at 22 bucks a share. So if the stock trades up to 25 bucks a share, I miss out. I miss out on that extra $3 of gain. If it trades at 24 bucks a share, I miss out on $2. Once it trades above 22 bucks, that's the most I'm going to get. So we sold the call option for, I believe it's a January call. I'd have to look at my actual brokerage account to see, but so I sold a January call for 22 bucks. At 22 bucks for 30 cents. So essentially, we're getting paid an extra 30 bucks for 30 cents per share times 100 shares. So we're getting an extra $30, a dividend essentially, into our account. And then once the company pays their next dividend, we'll get the $24 for the 100 shares times 24 cents. So pretty easily you can make this from a almost 5% yielder to a 10% yield within a year by just selling covered calls against your position, and knowing that you put your covered call in a position that if it gets exercised, it's okay. You're fine with taking that gain. Like, I'm okay with a 10% gain in just a little over 2 months. If we get exercised and we leave with a 10% gain, okay, great. So we make 250 bucks on 100 shares in 2 months. I can't complain about that, right? I would be more than happy to make 10% on my money every 2-3 months. So that's kind of how we played GE. Like I said, I mentioned on Friday that we were buying, but I wanted to put that out there in the Facebook Live. I think the YouTube videos are kind of dwindling off, and it seems like Facebook Live is probably the way to go to get this out there to help educate people. So if you have questions, you can leave a comment right here in the Facebook Live feed. Otherwise, I will still be putting this up on YouTube, so it'll be able to be watched there as well. But that's it, guys. Take care, and we will see you next time.